BTR. That's going to be the topic today. BTR or build to rent is the asset class we're going to be discussing. And so first of all, I want to talk about build to rent. What is it? What's the purpose of it? You'll hear it referred to as BTR or BFR, build for rent or build to rent. And someone might say, well, that is pretty obvious. All multifamily and all apartments are build to rent or build for rent. Now, the reason that acronym is used is because of it's the single family nature. It's something that is, most of the time you're building single family houses to sell. And you would build a duplex to rent, but not necessarily to sell. You would build, to rent. But single family, most people aren't building single families from the ground up to rent. But a new trend has emerged within actually the last 2 years post-COVID where they're building whole neighborhoods, whole subdivisions of single family homes, but none of them are for sale. They're only for rent. And that may be very intriguing to some of you. Some of you may not understand it. So that's what we want to dive into today. We love the BTR. Matter of fact, we have one of our offerings is a BTR asset class. We have a couple of them. They come in different forms. So it doesn't have to be necessarily single family in its purest form as in a standalone. It can be townhouses, but that's still considered single family, but a little more row oriented. But it's all for rent. And the idea is to have a place with a backyard, a front yard, a cul-de-sac, and still have the clubhouse and the amenities where you can, your kids can play in the backyard. It's not an apartment. You don't have to walk up 3 stories. You kind of have the American dream, but you're still able to move around. You're still able to, you don't have to fix anything. If you have something that's broken, you call the maintenance guy up, and you don't have to do it. All of that is very much simplified. So we want to talk about who is kind of interested in that, and do we see this becoming something very, very important? First of all, I want to go ahead and ask anybody, is anybody involved in investing in build to rent, BTR, or are they familiar with it? You can put it in the chat. Just say, I'm investing, or I know about it. I just want to kind of get a feel for what the audience knowledge base is, so I know how deep or how shallow to go when discussing it. And another thing is, if you're one of our investors, you get our monthly newsletter. And in our monthly newsletter, we have articles that we write. One of the articles I wrote actually was on build to rent, and I have the article here in front of me. I'm going to be got the camera backwards referencing this, but it's also, like I said, if you get the newsletter, you will have that also. Let's see, scroll down. Okay, somebody's working on originating senior debt for build to rent communities. Yes, been researching it and have construction. Huge risk is construction risk, relying on a strong relationship with the builder. Got it. Okay, great. Love it. All right, but I'm going to tell we're going to have quite a few questions about it, because as far as content's concerned, it's not going to be as much. But what are the pros of BTR? The pros of BTR are what I just mentioned. First of all, you open yourself up to another renter demographic. So most of the retention problems in multifamily are to families that are growing, and they lose their residents to single family homes, purchasing single family homes. Right. And that is not necessarily a problem. It's something that multifamily is designed, 1 to 3 bedrooms, and anybody above that, they're moving on and trying to find a home. Problem is, in situations, especially right now, we saw the housing market increase exponentially over the last year. And right now, interest rates are high, leverage is low, down payments are high. People are scared of the risk in the economy, and so they don't want to tie themselves to a mortgage. Plus, they don't know what their job's going to bring or whether they'll need to move. So in times like that, and when people are losing their houses, let's say, the 2008 housing crash, they have to live somewhere. And if they lost their house, they obviously don't have a down payment and, to buy a new house, and they're not going to be approved for that. But renting is. So let's say you had somebody, let's say in an economic downturn, you had a family of 4 or 5, that they were in a home, and now they're having to move out. They're having to live somewhere. They're going to trend towards one of these instead of living in an apartment. So, your 3-bedroom, home is a lot more spacious than a 3-bedroom apartment, or you can get 4-bedroom and so on. And so that's very ideal. It's kind of the hybrid of the American dream. So everybody wants the backyard, right? But nobody wants to take care of the backyard. So you'll see subdivisions go up and they'll look very nice at first. And then once the individual owners live there for a while, it kind of gets a little tired and weary looking. Well, that's all avoided in the build to rent communities because they are maintained by the property management company. So you have the economies of scale of multifamily because they're all in one location in a neighborhood. And you have the benefit. So you have the maintenance person and management companies, just like you do in multifamily. So there's a lot of benefit there. The benefit to the resident also is some amenities, like if you have a pool, a clubhouse, a playground. What better? A lot of the single family neighborhoods like DR Horton and Ryan Homes, Eastland Homes, they all have that type of clubhouse anyway. So that's very similar to multifamily. So you can see the similarities there. The only difference is we're not going up multiple levels and tying units together. And one would think that would be more expensive per door. And I think when you consider your overall development cost, you may be right at multifamily. But what I have found is actually the higher density of multifamily project, the higher the cost per door comes because of the structure, the infrastructure, because the land is the land, right? So you're not really saving that much per door. Let's say if I go from 150 units to 200 units and my land was, $2 million or something like that, the overall cost per door is not affected because of the cost of land. Where it gets affected is the type of construction, whether you're having to go concrete or wood, or whether you have to have parking garage, those things. So the higher density, the more urban multifamily with parking garages and such are much more expensive per door. But the revenue is higher because they're downtown and so on. So you can justify that. BTR tends to be a little more rural. So they can be a little more suburban than urban, obviously than like a mid-rise multifamily. But the benefit of it and some of the offset and the cost is in the simplicity to construct and the ability to stabilize it quicker. And let me explain that. So first I'll go over the simplification of construction. So because this is single family and not considered commercial residential, which is multifamily, it's residential, but it's still regulated by some commercial regulations, such as sprinkler systems and such, firewalls and different things like that, egress. All of those are a lot different for multifamily than they are for single family. Your codes are much different for single family homes, the way it's built, the type of everything, it's all different for single family homes. The other benefit, and so you have a slab, let's say, or a crawl space for your foundation, and then you build on top of it. It's very simple, it's cut and dry. And the beautiful part, like I said, you can stabilize faster is with multifamily, you have to get a whole building built, and then you have to finish it. And then you have to get COs on the whole building. Well, with single family or build to rent, you can occupy those one by one. So you can build one, get a CO, certificate of occupancy is what I mean by CO. You can get the CO and you can move on to the next one, get another CO, move on to the next one. So you're building, occupying, building, occupying, building, occupying, instead of building 50 units and then occupying 50 units and having like the time to occupy 50 units and maybe some of those sitting vacant while you're building the other 49 units, if you will. What are some of the cons to build to rent? I think it's a newer asset class. I think debt is still something that needs to be solidified. There is the lower density. You're not able to pack as many on as you did in a regular multifamily. The rents, however, this goes back into the con. That was the extent of my con section. This goes back into the pros. The amount of rents is typically based on square footage in multifamily, and with the larger square footage, therefore larger rents. And so there is some good benefit there as far as the rent. So the problem with buying them though is that pushes up the price per door. But that's one of the pros of it on the exit side, because no matter what you want to enter, with the idea of exiting. How am I going to exit? And the great thing about build to rent is that it exits at a very high number. So if your cap rate, cap rate is indifferent. It doesn't matter what market you're in. Price per door is what I'm looking at. So we've seen these trade for 500,000 per door. Most multifamilies are trading for 260 to 350, 250 to 350 per door on average, let's just say. So these are trading much, much higher per door than a multifamily deal. Now, keep in mind the density is lower. So when you don't have 150 on a piece of property, you might, only have 50 on a piece of property. But your rents are much higher. So and your cost to build is I think lower than multifamily. So that's kind of the trade-off, and that's kind of the way it interacts. But who are the people that are looking at BTR? That's what I want to dive into next. But before I do that, talking about the demographics behind it, let's take some time for some questions. I want to look back through because I've seen some chat activity occurring. So we got some current development. Current have 6 projects in Carolinas for BTR. All right, excellent, very good. And somebody's looking at another huge deal. Huge risk is construction risk and relying on a strong relationship with the builder. Yeah, that's always a big one. Knowing who you're dealing with, who the developer is, investing in a development deal, you really have to know who the sponsor is and if they have experience. That's something that we actually are doing more of. You'll see a lot more development deals come from us in the future because of that, because you know us, hopefully you like us, and hopefully you trust us, right? Those are the 3 things that are going to cause an investor to want us to invest their money, is to know us, like us, and trust us, as you've heard Dan Handford say many times. So we want to go ahead and start in the development process so people can feel comfortable investing with us. And we're, bringing on some very knowledgeable people in that field. So if anybody's interested in that, you can always reach out to us, but just keep an eye on our deal flow. But it always is a factor of building to know who the builder is and who is going to be developing the project. It's just like single family homes. It's just like multifamily. You have very well-known developers that build a beautiful product. And then you have some that build, they're brand new, but they're not class A, they're more economic, if you will, and not focused on the class A. You have builders the same way. You have the very, cheap track home, cookie cutter, and then you have the nicer, a little more customizable people in the space. But as far as that goes, if you want to talk about success of an investment, look at people who have been in the single family market for years and years and years, like D.R. Horton and Ryan Homes. They both have build to rent arms of their business now. So they're doing this now because they understand it makes more sense, because instead of a one-off sale, they get recurring revenue. And D.R. Horton is debt free. They do everything with cash, which just blows my mind to be that big of a company and not use debt. But it's great. They're a great company. We have purchased from them before, and they build multifamily as well. A lot of people don't realize that. They see D.R. Horton as the single family home builder, and that's what they're known for. But they have seen the writing on the wall for BTR development, and they are in this. Blackstone has also gotten heavily involved in single family rentals. If anybody on the webinar today is in fix and flip, like we talked about Rehab Wallet earlier, then you understand single family rentals. What we're doing now is combining the beauty of single family rentals with the beauty of multifamily, with the economies of scale and being all in one location. Because that's what we didn't like about the single family rental market is I have a house here, and then 3 miles away I got another house, and I got to drive over here, and then I got one in another town, and I've got one over here, and they're not all together. So I can't send one landscape crew out to hit all the yards in one shot, and therefore saving me money. So when I centralize all of my rental properties in one property, I've saved myself money from economies of scale. And now if I make those single families and multifamily, I've increased my rent per month on an average unit because of the size of the square foot size of it. And I've opened up the passageway to a whole nother renter demographic, and that is people who are sizing out of or aging out of the multifamily. Another aspect of it is even age restricted multifamily communities are something that's really big nowadays. 55 plus, and it's age restricted. You can't move in. They don't want a lot of families. They want it. It's kind of like a retirement community. That's a big thing in Florida, and a lot of the multifamily communities are built for that specifically. This works very well for that, especially with your patio homes, with no stairs, easy access, but you get that sense of your own home, but you don't have to take care of anything. So it's like a condo, but even better, you don't have to purchase it like you did a condo. You have to worry about selling it. And when your lease is up, you want to move to another state, another city, you can do that and not have to worry about that. So that, and right now too, the biggest group that's interested in BTR is the millennial group, and I mentioned that in my article. Something about 80 million strong in the U.S. housing market right now, and Gen Z also having big housing aspirations. I think the whole paradigm has shifted with the buyers and not needing to have, the average stay in a home before in my generation was 5 years. That's no longer the case. It's much less than that. And the millennial and Gen Z are reinventing the housing rules, and they're thinking outside the box and doing things differently, and thinking of the things in a fresh new way. And so they are the target demographic for these, even above and beyond some of your 55 plus. Just because sometimes we've had a mindset in our mind of always own a home, never rent. Sometimes it's hard to change that mindset in some of your renter demographics, but the millennial and Gen Z kind of get that, especially now. Again, I'm going to tout this again in this economy. It helps to have this because, in 2008, when I saw people losing their house, everybody has to live somewhere. Where do they go? They rent. So right now is a perfect time with people not being able to buy houses. They want to upgrade, or they just had a baby or another baby or the fourth baby or whatever the case may be. They need a bigger place there, and they can't buy one now because the interest rates, or they're scared they can move into one of these. One of the questions that we have right now is it good to have two different size ranges in the BTR? And yes, I definitely agree that you should have multiples. It's just like in any single family subdivision, a regular tract home. They're not all exactly the same. It's very much the same. So we just aren't doing any like 1 bedroom or 2 bedroom in the single family, because that really doesn't work for a single family. If you were to ask anybody, what is the number one thing that you need to have in a single family home for it to sell? And that's 3 bedrooms, 2 bathrooms, period, end of story. Master on the main also is the big one. So we're providing that with that. So I would say a minimum of 3 bedrooms. If you go 2-story, I would recommend putting the master on the main. That way, no matter what, you are able to open it up to as many portions of your customer base as possible by having the master on the main. But I would also have some, you could have, some with what in the South they call frog, that's the free room over the garage. I call it a bonus room over the garage. That's a big popular thing. So you can have that as options. One with the bonus room, with one without the bonus room. You can have it with a 4 bedroom. You can have one with a study, but that can double as an in-law suite, just like your single family homes. But I definitely think that you should have options, because that frees you up. Again, you want to open it up and have enough variety to capture as much of your target market as possible, but not so much variety that you confuse and it's just too much, which sometimes is the case with the single family construction. Okay, do you want brass doorknobs and silver doorknobs? Do you want this and that and the other kind of mirror that? That I don't think you should get that far into the weeds on. And you can a lot of times let them pick paint colors and you can paint that for them. But the biggest thing is they don't have to mess with any of the maintenance or mowing the grass if the water heater breaks, or, in the South, I don't know, if anybody had any freezing, I know a lot of people that had some frozen pipes and had to deal with all that. The owners will deal with all that. You as the tenant and the tenants that you'll be renting to do not have to deal with that. So that's a very nice factor there. So I want to go ahead again and open it up to some questions. I've been rambling on. for quite some time now, and I want to go ahead and ask a few questions because, again, our time is short. We've been on for already 30 minutes, and I know I talked a little bit at the beginning about some of the conference coming up and things like that, but I want to make sure that we focus on the BTR and answer any questions that you have, because I know that some of you have mentioned that you're and interested. Ideal size for a BTR community. Let me see if I can show you even one of ours, and it's a little bit smaller. And I think that for some, I think that's a great starting point for some people just looking to get in. If you can get like a 10 unit build to rent, if you can find 6 acres and develop it and get a few of those, it's great. Like, it's the same thing as buying 6 rental houses and building that portfolio, but they're all in one location. You get the economies of scale. Obviously, the bigger the better. So, I mean, you can get 300 home subdivisions. It's going to cost you an obscene amount of money to get something like that. So most people, including our group, would not be able to take down a deal that size. But give me 1 second. I'm going to pull up one of our properties. Stepping Stone at Bridgewater. Let me see if I have some pictures. Just bear with me for a second. I'm going to pull this up. This is a property we just closed on. Here we go. All right, can everybody? Yeah, all right. We can see that. So this is the size. I'm trying to see if we have an overview here. Let me go to the gallery. This is basically the way they look. Okay, so pretty basic, nothing fancy, but nice screened in. This is in the Myrtle Beach area. All right, just to give you an idea what I'm talking about. See these here? That's kind of connected more like a duplex. Let me look up the actual overview. This one only has, let's see. You can watch me browse here. 1 second. Apologize for that. Should have this ready for you. I just wanted to show you the overview. Obviously, this is before the grass is going in, but 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22 units on that. So that's the size of one of the ones that we have. We also have another townhome community in the Wilmington area. But so nothing huge there. That we're starting out, but again, the price per door is a little bit higher, but your rents are higher. But there's waiting lists for these properties. Like if you're familiar with multifamily, you understand that 3 bedrooms are the most desirable, and they usually have a waiting list. But they usually only change during when school's out. That's when the leases usually expire. So you're not leasing these right in the middle of school year most of the time, because it's families and they have kids and they go to school, and most of the time they don't want to pull their kids out of school in the middle of the year. Same thing with the BTR. They're much more stable. They have waiting lists of people that want to move in. So your occupancy is usually going to be at 100. We obviously don't underwrite for 100, but that is where your target can be. And as long as you have your rents correct. So your stability, your longevity, your lease retention is going to be much, much better. We have capital stack look like on BTR deals, lending, equity capital, etc. The deal structure is no different on BTR than a multifamily deal. And you can do that any way you want, like 70-30, 30 being GP, 70 being LP. And that, and that makes up the portion, the debt, whatever the debt is, that changes constantly right now. So, we're only able to get 55% to 60% leverage currently on most deals, sometimes a little bit better. So that structure is going to change, but it's basically the same thing. And so it's the familiarity with the product in the lending space that is still needing some time to grow on some of the private lenders. And this year is the first year, or I guess 2022, they recognized this NMHC, National Housing Multifamily Council. I can't remember how that goes. NMHC, it's the conference is coming up in February. It's the first year that they've recognized this as its own new asset class. And so there'll be meetings designed specifically for build to rent communities. And then a lot of the conferences that I've been going to have been discussing this at length. But they function as far as the structure of them, they function the same way as multifamily. To recommend any kind of analyzer that can be used to figure the numbers out for this kind of project. No, that's, we use our underwriting model, and we use the same type of model, the same model that we use for multifamily, because it's the same thing. I have my price per door, cap rates, rent per square foot, and the expenses. We do talk and adjust those expenses a little bit, but the spreadsheet that is still the same. That is something that you just have to build out. There are some spreadsheets out that you can do it in a pretty simple way, especially if you're only going with something pretty small, let's say a 10 unit. I don't think you need any complicated deal analyzer. You just need to look at your expenses. You're starting with your debt service, and then, your property taxes, and insurance. Those are your largest ones, right? And then you come in with your management company, those expenses. And then you have, maintenance, utilities, common areas, et cetera, et cetera, et cetera. And then your rents are pretty much there. And you can look in the market to find out what those market rents are, to find out where you're pricing. But typically you're still going off of some of the multifamily rents. You're able to push that a little bit higher. That's stabilizing a little bit, but just look at what single family homes are renting for in the market. I mean, you can find that on Facebook Marketplace and different things like that. People list those single family rentals more privately as opposed to like a website like this place has. If that answers your question, but I don't have any specific analyzer per se. It's going to be the same underwriting as multifamily. It's the same animal, different breed, basically. Look over here. Got that. I think I've answered all the questions in the Q&A and in the chat. So if you have any more, go ahead and pop them up now. If not, I want to go ahead and wrap up for today. I know everybody's busy coming back from the holidays, and I did mention at the beginning, we're going to keep this a little bit shorter than normal. But if you have any further questions, feel free to reach out to any of us. It's a first name at passiveinvesting.com. So it might be Brandon at passiveinvesting.com. You can Dan at passiveinvesting.com or Danny at passiveinvesting.com, or any of our team members. You can go onto the website that I showed at the beginning, click on our team, meet the team, and you can get our contact information there. We're happy to answer any questions that you have. We're not experts in this field. We're not experts in any field. We do our best, and we like to share as much of the knowledge that we have with you, just to help you. We don't charge for these webinars. These are, we want to give as much information as possible. And so we're happy that we could do that for you. But we're still learning with you. So join us next week. I think, let me see if I have this back up, because I want to go over what we're going to be going over next week. All right, trying to go. All right, here we go. And this will be a good one. Just share the screen again. All right, so Eric Fitzgerald, he's my director of acquisitions. Eric's a great guy, and is over the whole acquisition team. We do car wash, self-storage, multifamily, hotel, BTR, and also development, land sales. So he's going to be talking about building and maintaining broker relations for multifamily investing. That's going to be next week in 6 days, and he's going to be talking about how to stay on top, how to stay top of mind with busy brokers. And we've gotten this information directly from them. It's not just us telling you, it's them telling us what to tell you from the broker's mouth directly. How to be the first buyer call they make, how to negotiate and interact during the offering process and so much more. And Eric and I have worked close together, so he knows what I know and has probably learned some things that I don't know. So be sure to tune in next week. We're thankful to have you today, and I hope you have a great new year and a great rest of the week. Thanks again.